but that would not cause the market to do that, okay? The 2008 financial crisis took a year to bottom out, and it took a total of 5 years just to get back to even. This bottomed out, and was higher in 5 months, not 5 years.
Bear gang till I die, ho. Swooped up the homies and we about to start a sideshow.
I only want to do this real quick because a lot of people in here are always saying, "Hey, Stocky, why doesn't the Fed just print more money?" Or, "Hey, Stocky, how come Trump doesn't just, tell the Fed to lower interest rates?" Okay, so let's look at this real quick. Let's do this in a very, non-crazy way, okay? All right. Federal Reserve versus, and I don't mean versus like they're going to be in a fight to the death, but versus the Treasury, okay? Okay, I'm just gonna put it this way. We all know the difference between monetary policy and fiscal policy, right? Monetary policy is policy regarding how much money there is, where that money, the amount that money is loaned out at. Fiscal, which is done by the government and the Congress and the Treasury, is where that money is allocated. Okay, so the Treasury's job is to collect taxes through the IRS, okay? Print money. So the actual money that goes into circulation, right? The money that you hold in your hand, which almost nobody uses now. Their job is to print that, okay? And to give that money out. Also, advise the president of the Treasury, advise the president on trade issues, sanctions, etc. Okay, so they actually do the legwork, right? Like they're in charge of the actual money, right? They print out money, they put it into circulation, they make sure the coins, the mints, they take the loans from the Federal Reserve, they disperse the money and whatnot, right? And they issue bonds as well. Okay, what is a bond? A bond is basically an IOU, right? An IOU, and it says, hey, we're gonna give you this bond as a person or so whoever buys it, and it's an IOU, and you give us money for this bond, and we'll give you a percentage in interest when it matures, right? Whether it's a 2-year, a 10-year, a 20-year, a 50-year, a 100-year, either way, it's basically an IOU. All right, so that's what you have there. The Federal Reserve, on the other hand, is in charge of inflation, dealing with unemployment, okay, as well as interest rate, okay? Before I go any further, I want you guys to understand something, okay? And that is that the Federal Reserve is only federal in name, okay? They're not actually part of our federal government. They're not controlled. Our government cannot go in and audit them. The Federal Reserve can say we have $7 trillion on our balance, on our balance sheet. They could have 20 trillion. You'll never know because they're a separate entity. They have nothing to do with the government. They are as much a part of the federal government as the Federal Express, okay? It's just in name only, okay? So when you guys think, well, how come Trump or how come the government just doesn't tell the Federal Reserve? Because they can't. The Federal Reserve is a centralized bank that is a separate entity from the government. So that's not how this works. They do their own thing, okay? They want to do things the right way because, they don't want to collapse, but this is a Federal Reserve, all right? All right, so how do they do this stuff? Okay, so what happens is when the Federal Reserve, okay, all right, what they will do is they will adjust interest rates. Now, what is an interest rate? Well, interest rates are the amount of money that they lend money to banks at, right? So if you're a bank, okay, and you have to keep a certain reserve, you have to keep that's why they have the thing called fractional reserve lending, right? They have to keep a reserve of the money they lend out on hand, right? But if they want to lend out more money, they have to get that money from somewhere. So they get that money from the Federal Reserve. The Federal Reserve lends them that money at a specific interest rate. Now, if interest rates are high, the bank then has to borrow that money at a higher amount, which means when they lend that money out to you, either through a mortgage, through a credit card, through a vehicle, loan, they have to charge you even more interest to make enough money to pay back the interest that they owe, right? So if they get their money at 2%, they're going to give it to you at maybe 3 or 4%. So now you as a person have less money to spend, right? It's harder for you to take out money. Money's not as cheap, so you spend less money, all right? Because they got to make their money back, right? So you take out a mortgage, you're paying a crap load of money back to the bank, and that means less money in your pocket. So what the Federal Reserve will often do when they need to speed up economy is they'll say, you know what we're going to do? We're going to lower interest rates, okay? Because we talk about that a lot right there, all right? They're going to lower interest rates. So they're going to lower interest rates as of right now to 0%. What that means is that banks can now borrow the money from each other from the Federal Reserve at 0%. Meaning, in theory, that when they lend money out to other banks or to people, you now pay less in interest as well. Because the bank needs people to still take out money, but they want to keep it in line. So this is the idea to keep the economy going, right? Make sure that the interest rates are lower. So when banks borrow money to lend out to people, they also get a lower rate, meaning people have more money and they spend more money. That's the idea. So now I can go out and get a mortgage at cheaper than I did before, or my credit cards, or my vehicle, or, whatever. I can get money cheaper. Now, this generally trickles more into, the billionaire who's borrowing, $500 million at 1% instead of 5% because there's a big difference in compounding interest there. So that's what the Federal Reserve does. So recently, we saw the Fed drop interest rates from 2.75% down to 0% in order to give the banks more money at a cheaper rate to lend out to more people to stimulate spending. Okay? Now, on top of that, you have the federal government using the Treasury to also give stimulus to people. All right? Now, another way that these two work together is the Federal Reserve is doing something, because remember, these are short-term interest rates. These are interest rates that deal with the next month or 2 months or 2 years or 3 years, whatever. But to keep an economy going over a long time, you need to keep interest rates down for the long haul. How do you do that? Remember these bonds? These treasuries? The Fed is buying them up. They're buying the Treasury's bonds, basically buying the debt from the Treasury. So the Treasury is like, listen, we're spending more money than we're getting in taxes. This is a problem. We can't fund our military. We can't fund our infrastructure. We can't fund all of our issues. We can't fund them. So we need money. We either raise taxes or we take on debt. Well, you can't raise taxes on everybody because then there's less money to spend, and less money to spend means the economy slows down. So we are going to offer our bonds and treasuries up to sale. Well, normally private investors and governments do that. For example, China owns, I think, 1.5 trillion. Japan owns 1.1 or 1.2 trillion. Okay? They own all that. And that's basically where the Treasury gets money. Now, the Federal Reserve, on the other hand, is now buying up junk bonds, junk mortgages from banks, but also buying treasuries from the bonds and treasuries from our actual Treasury. So what you're seeing is that it gives a confidence, okay, in those treasuries down the road. Okay, interest cannot go lower. What can they do to further incentivize spending? Okay, so if you want to look at it that way, what can the Fed do besides interest rates to affect inflation? So, all right, so Federal Reserve has lots of tools they can use, all right, to affect inflation. All right, Fed and inflation. Okay. Number one, there are 3 types of inflation that we're going to focus on. We talked about them before. We'll talk about them again. Okay. Number 1, CPI, Consumer Price Index, or core inflation. Okay. Number 2, real estate. Number 3, equities. Okay. There are several more. I'm just going to focus on these so we don't get out of hand. Okay? All right? Now, what are each of these done? Core inflation, that is the price of everyday goods. Now, I think it should personally be tiered and leveled, but in this case, it is going to be everything from the price of a car to the price of an apple to the price of a haircut to the price of going out to eat, okay? Lots of ways that are affected it. Inflation is basically, for those of you who don't know what inflation is, it's basically simple, not simple, but we're going to call it simple supply and demand. All right, how much of something is out there, how much it is wanted. All right, whether it's currency, whether it's apples, whether it's streamers. Okay, so core inflation, the price of everyday goods. How do you affect, if you're the Fed, core inflation? Anybody got an idea? War? Never mind. All right, so how much money people have, how much money people are spending, and how much of demand there is, okay? People can have money, but if they're not spending that money, it doesn't really matter. That ends up in inflating the value of the currency, not just goods, okay? So the value of currency is everyone has money, no one's spending it, there's a bunch of savings, it's not working. If they're spending it, so that's why the Fed came out and said, hey, we want to focus on employment. We want people to be gainfully employed to make money and continue to make money and continue to spend, all right? Now, real estate, several factors. Regular supply and demand, but also interest rates, okay? Borrowing. If money is cheap, okay, if interest rates are down and money is cheap, banks are lending money out, more people will buy houses if they're employed, right? And if they have gainful employment, they have regular income. If more people are buying houses, all right, eventually, if there is a lack of inventory, which there is right now, an artificial lack of inventory because of the moratorium, real estate prices spike. So we'll see it. For an example, we talked about this the other day. Average price in 2000 of a home, $149,000. Today, $409,000, okay? 50% increase in inflation, okay? And 35% increase in real estate value. All right? Big difference there. That means we're on pace for 2040 for the average house in America to be $800,000. Now, equity inflation is a whole nother word. That is people using their money to buy into equity of a company, all right? And we saw that with the Federal Reserve recently. Let me get back to this. How does the Fed affect inflation? Real simple. Rates and borrowing, okay? What are the rates of borrowing money? If the Fed makes it high, less money, less spending, inflation goes down. Rates go low, more money borrowed, more money spent, inflation goes high. That's the explain like I'm five version. That is as explain like I'm five a version as I can, okay? That's how they do it. Now, there's other aspects. They can buy debt, which is what they're doing right now. They're going to all these banks right now, and they're saying, oh, you have crap underwater mortgages and loans and all this stuff that's junk. Here's what we're going to do. We're just going to buy that from you and take that off your balance sheet. And we're going to add it to our $7 trillion balance sheet. And now you have more capital to lend out to more people. So even if they lower the rates and it's not working, they can now buy up debt from the banks to clear their books up to allow them to lend out even more money to jumpstart more spending. Does that make sense? Sounds like an addiction? Yeah. Can they erase that debt? Technically they could, because they're the ones who hold that debt. However, if they forgive that debt in America, then what happens to the central banks in other countries, and does it become a free-for-all? We have deflation and hyperinflation. So that's why the Fed said, hey, listen. All right, remember in 2000, okay, I'll give you a great example. In 2008, we saw when the market was crashing, all right? When we saw the market crashing and we went into the 2008 recession, what is one of the things that got us out of that recession? What got us out of that recession? One of the things were rates were lowered, okay? The rates got dropped, okay? Interest rates were lowered to 0%, okay? Drugs? No, not what got you through it, okay? So we bailed out the banks, yeah, which is great and all. That was all a dog and pony show. But 0% interest rates flooded the economy with money that shouldn't have been there. Now, all of a sudden, people had money. They could borrow. They could borrow money. And because remember, when interest rates were at 3 to 4%, it was expensive as shit because that's what the bank borrows it at. If the bank is borrowing at 3 to 4%, they're giving it at 6 to 7% to you and me. So nobody's going to take that. Who's going to take a 6 to 7% loan? And if they do take a 6 to 7% loan, what are the chances of them defaulting on that loan? It's pretty damn high. So by dragging the interest rates to zero, okay, the banks get it at 0%. They loan it out to 1 to 2%. People can afford to take out money. They take out money and they buy houses and they buy cars and they use credit cards to consume spend, okay? And when they do that, that money flows into businesses. And when those businesses go, now you need to build the houses. So they go and they buy lumber and they buy concrete and they buy things from other countries. And those other countries are now importing here and it's going, it's a circle. And that jump-started the economy. Then when we bottomed out and started going back up, then the Fed started raising rates again because they can't keep rates at zero forever. Because if you do, then you get into hyperinflation. So they have to balance it out. They have to balance it out. Up, down, up, down. From 2014 to 2018, I think the Fed raised interest rates something like 8 or 9 times, if I'm correct. Now, they've said right now that they are going to keep rates at 0% for the foreseeable future because they feel like here's a little thing for you. Remember, we all talked about that the market and the economy are not the same thing. But why would the Fed say 0% interest rates possibly for 5 years? Either A or one, they're trying to instill confidence. So they're basically debating everybody and saying, hey, guys, don't worry, borrow as much as you need. We're not going to raise interest for 5 years. Or we can't, we're not likely to do it. They're not going to say they're not going to do it, but they say we're not likely to do it for the next 5 years. Or 2, expect a long recovery. That's what we're looking at with that. Obviously, they're in charge of monetary policy and not fiscal policy. Our government is in charge of how the money is spent. Confidence and recovery. So remember, the market is not the economy. Stocky, the economy is tanking. If the economy is going down, why is all this money going up? Or why is the market going up? 1, free money. 2, greed. 3, retail traders. 4, future. 5, equity inflation. 6, YOLO. That's why the market keeps going up. I did an entire video on why the market is going up if the economy is going down on YouTube if you want to check it out. And treasuries are continuing. I mean, treasuries are up today, but treasuries are continuing to plunge. Refinance your shit now. Okay? If you haven't refinanced your house yet or you just thought about it, just so you are aware, Fannie Mae, Freddie Mac are looking to put in about $1,000 to $1,500 per house, depending on how much your house is, fee for refinancing because everyone's doing it. It just got held up in court for the short term. So you might want to get on the ball about refinancing, okay? You could save several hundreds of thousands of dollars potentially on your home, on your mortgage, if you can refinance at a lower rate. You might want to start not dragging your feet anymore because when that penalty is lifted or when that injunction is lifted and the penalty is getting paid, you're going to pay, in some cases, more than the closing costs just to refinance. Don't use Rocket. I don't care who you use. Technical advancement, mass value creation. Yes, Montreal, that is in a normal issue, but that would not cause the market to do that, okay? The 2008 financial crisis took a year to bottom out, and it took a total of 5 years just to get back to even. This bottomed out, and was higher in 5 months, not 5 years. It's a big difference in what we're talking about here. Big difference between 5 months to drop and exceed versus 5 years. Now, granted, we're in a different society. Okay, we have different type of trading and different type of money flow and different type of monetary influxes. But this is that 0% interest rate. Okay. For example, remember when we said that at the beginning of this that we would see the greatest transfer of wealth in human history during this time? That's exactly what has happened. While the average Americans, and I'm not getting political here, I'm just giving you guys the numbers out there, okay? While the average American's personal income and savings is highest that it's ever been, there's a reason for that. Number one, on savings, $1,200 stimulus check was passed around. The idea of a stimulus check is to give people money to buy to stimulate the economy. Nope, everyone dumped it in their savings account. Guess what? That automatically means savings are higher than ever. Unexpected money that everybody put in there. Personal income, $600 per week on top of $200 per week on unemployment. Okay, it's $800 per week. Okay, 816, it's 32, it's about $40,000 per year. Okay? Many of the people, not all, but a vast number of people were not making that much at their jobs. So now they're making that, which means the median income in the United States rose, meaning personal income was the highest it had ever been. Well, that makes sense. If all the people that work minimum wage go from making $12,000 a year to an average of $40,000 per year off of the unemployment bump, that's going to raise personal income. So when you look at those numbers, you're like, well, shit, everybody's winning. No, this is temporary. This is temporary. Okay? When this goes down, okay, these people are going to make less money, and you've got, look at Bezos. I'm not here to shit on rich people. I'm just giving you an example. Bezos, Musk, Gates, and Zuck. Before this versus after, every single one, all four of them have something in common. Do you know what it is? As of yesterday, or as of Monday, every single one of them are worth over $100 billion. 4 months ago, you had one. How is it that during the greatest short-term financial, whatever you want to call it in the world, that happened? How did that happen for Musk? Have you seen Tesla stock in the last 3 months? I mean, he probably lost 8 to 10 billion today. But he never lost it because it's not a loss until you sell. So, and that's not me making a political statement about should people be rich or not rich or anything like that. I'm just letting you know, while everyone else is facing this is what happens in these things, you know, when the equities go up like this.